Good morning, everybody, and welcome to the Daily Energy Markets Podcast. It is April the 30th, the last day of April, the last day of the first month of the second quarter, and Brent crude oil is trading a little bit, flat, I suppose, 88.21, down a few cents. Generally, a downward pressure, a downward draft on oil prices on the back of the news that there could be a ceasefire of some description announced in Gaza in the coming hours or days, or perhaps failing that, the exact opposite, something very dramatic and horrific attack on Rafah. So it seems like we're on a precipice of either falling towards a ceasefire or falling into a deeper hell. Oil prices betting on the former ceasefire likely to happen. Let's kick off with Peter Maguire, CEO of XM Australia. Peter, oil prices down. They've recovered a little bit, but they were down over 1.5% when the New York Times reported yesterday that this deal could be done. I was kind of thinking that we'd drained all the geopolitical risk premium out of the oil markets. How much of it is still left, do you think?
Well, good afternoon, Sean. Greetings from Sydney and hello to everyone. I think there's still a fair few dollars wrapped up in it, and when we think about all of these moving parts in consideration of the geopolitics and, the whole matter certainly has got far more legs to run, then I think that there's probably, $5 to $8 in there, maybe even more. It's been very volatile, as we've seen, and it's been, from a trading perspective, it's been, I think, very attractive. And so is all of the commodity complex, because, you've only got to look at the likes of copper now through 10,000 a metric ton. It's up the best part of 20% in the last couple of months. So, you've got the overall theme, Sean, of industrial demand picking up in China and prices for commodities staying fairly solid at this early in the season. So, I think there's still a fair few dollars wrapped up in it.
A fair few dollars. It certainly feels like they're squeezing it out. But Noor Azlin Ahmed, Managing Editor, Asia Argus Media, your thoughts on direction of travel? Geopolitical risk is still obviously in this price. Where is the basics of supply and demand, particularly demand from China? Where's China at now as we go deep into, we're about to go into the second third of the year? We must have a good picture of the health of Chinese demand by this stage.
Yeah, I mean, I think right now, the Chinese oil demand rally is actually, we see running out of steam a little bit. I think that in the first part of the year, in the first quarter, particularly, the demand was pretty strong. Their refinery runs were supported, because of the Chinese New Year, and then runs were also supported because to supply China's spring construction season and higher LPG imports. But we see that diesel consumption has actually underwhelmed. And diesel stocks, state-owned companies' diesel stocks are now 20 percentage points higher year on year, according to Argus survey. So there isn't really a shortage of supply of products in China. And I think that the one thing right now, margins for products, especially with gasoline, not really looking great, and actually refiners are looking at possibly more export quotas to allow them to export and boost margins a little bit. So to be honest, the China demand actually has been a little much lower than what I think we're expecting, and seems to be easing after the slight strength in the early part of the year.
Shoaib Boutamin, energy advisor and CEO of Ranadrill Consulting. Shoaib, OPEC Plus, looking at this, they're on the top end of the demand growth for this year, 2.2 million barrels a day. Most others are down closer to 1.5. Your thoughts of where it's panning out at this point, and will OPEC Plus have the option to unwind cuts in the second half?
Yeah, good morning, Sean. I think that the big problem, before we talk about the demand, really the prediction of the OPEC 2.2 or IAA or 1.2, I think we have to evaluate the demand, really the demand, the fundamentals of the market. When we see the inflation rate at the moment in the United States, it's just increased from 3.15 to 3.48. It's an increase with 10%. And when we see the federal now in the US is not really, it's like not only taking decision at the moment to lessen the interest rates. So from this, we can really decide, we can see that really oil and gas, oil demand at the moment really is not really high. But what I believe in the upcoming, the end of May will be like watershed moment for the OPEC Plus, because the OPEC Plus will have a meeting in the 1st of June, and they will decide if they will keep the voluntary cut of 2.2 to the third quarter. And I think that by the summer, the demand will increase because travel will increase, demand on oil will increase in the US for the gasoline and on the oil, and even for Europe. Europe also will get, we need more oil and more also gas, but to restore, to refill up its storage of gas. So demand and energy, I think will increase, but will
OPEC Plus be compelled to meet that increase, or look for it to be met by draining down some of the inventories?
Yeah. This is the main concern. If we see now the US SPR at the moment, the United States is filling up with a very slow pace, but it's filling up its SPR. So the demand is increasing, but the big problem we have, the interest rate is still high. The inflation, the US and Europe is still striving and struggling the high inflation. But this is not really the core problem, I believe, at the moment is also the demand in China and India. China, the output, the manufacturing outputs are a little bit increasing, but very weak in the last month. So when we see high oil prices, so we don't expect to have very good demand on oil when we have a barrel of $90. This is we have to agree about this. If we want to get more demand of oil, we need to get prices to go down to 80 or 82. You cannot open the appetite for the consumers with these levels of oil. So if prices go down to 80 or $78, I believe we can expect more than 1.7 million barrels of demand per day. So this is the equation at the moment. If we want to increase the demand, yes, we can get it, but not with $90, I believe.
Not with $90. Peter, the question on a sort of more macro level, we have the Fed due to meet later this week. Your thoughts on what sort of relevance that is at this point for the commodity markets, and what sort of direction do they point us towards?
Well, I think first off, Sean, you've got US core PCE came in March 2.8%. Inflation remains very, very sticky. We understand that there should have been a rate cut pretty much at tomorrow's meeting, if you put your mind back, say, 3 months ago, and that was pushed out from March. Now there's talk that it's going to be, closer to September. You've got an election early November. You've got Larry Summers, emeritus professor at Harvard, saying 20 to 25, if not even 30% probability of a rate hike, not a rate cut. So these are all the impacts. You've got solid push up as far as base metals. They've had an enormous rally to the upside. Grains and across the agricultural sector is fairly hot. And when you're thinking about where you are with the likes of gold and its little brother silver, they've had big sell-offs, about $100, but nothing too tremendous considering
a lot of profit taken, you'd think. I mean, my gosh.
Oh, Sean, it's been an outstanding trade. I mean, it's been showtime since the early part of October. 1,800 to 2,400. Where do you find blowouts like that? $600 move, 35% in. It's nearly as good as Nvidia.
It's scary what it's communicating, though. I mean, and you'd think gold moving like an Nvidia stock, like a growth stock. There's a cuckoo in the coal mine somewhere. Just don't know what the coal mine is.
Well, I think it's going to be, when do you see rate cuts? What happens as far as commodity consumption? And I think the overall picture is going to be relatively strong, I think, for demand for the likes of crude and for price. I believe it'll edge up higher from here. Everyone's saying that copper's got the capacity to be the best part of nearly 12,000 by the end of the year, currently at 10,000, and only a couple of months ago was, nudging 8,200, 8,300. So, there's a strong appetite out there, Sean, and copper's a wonderful barometer for world economic health. So I think at the moment, if things escalate geopolitically, I think oil prices will certainly surge from here. And I'm keeping a very close eye on US dollar index, because I can't see that the US dollar is going to actually tail off anytime soon. I think the first one to cut will be probably Eurozone, considering how they're looking. It's anemic at best. And that's the lay of the land over the next couple of months.
Noor, on that point, I mean, where the Fed goes with the price of money, does it matter in Asia? Does it matter in Asian demand? And where we started the year with a big market expectation of 7 rate hikes, or 7 rate cuts, rather, the opposite. The dollar grew increasingly strong when that picture faded. What is the fallout for Asia and Asia buyers, particularly gas LNG side?
Yeah, I mean, I think that in terms of the rate hikes, the impact, I think the biggest impact will be what it does on the dollar index, and that how for consumers. So it's not a huge impact on demand, but the fact that the buyers are buying it in US dollars, I mean, I think it does have a filtering impact on where the prices are going. So you do have a lot of consumers in Asia. So the main thing that people will be looking at is what impact it has on the US dollar and for the consumers. So
what about foreign debt? I mean, foreign denominated debt.
Well, I think we don't look so much on that one. I think that it's not a time when demand is super strong in Asia, right? And right now, the expectations is that if the oil prices keep going up, a lot of the OPEC producers might start leaking out. So you can see that where prices are right now, despite the continued OPEC cuts, we're still barely above $90. A lot of it, I think, is geopolitical. And if there is peace, I think that we could drop a few more dollars, which is good for the consumers in Asia. So I think that could at least be good for the Asian side in terms of the consumers.
Shoaib, where does it leave the likes of new expansion of capacity in places like Algeria? We're seeing Saudi back away from new capacity, UAE marching ahead to 5 million barrels. Iraq seems to be always adding. Your thoughts of where this price frame and the wider picture goes for new supply coming out of North Africa?
Yeah, I think that the priority of North Africa region, I'm talking about Algeria at the moment. The main concern is to respond to European request, which is natural gas more than oil. So Algeria at the moment is shedding light more on the exploration and development of natural gas fields, because this is the demand. So as you know, the gap left by Russia in the European Union countries left a very big gap. And no country really could replace Russia at the moment, except...
Not one country, but certainly America's given it a good try. Yeah. I mean, it's unfortunate Algeria didn't think about this before.
Yeah, but nobody was expecting there will be a war in Europe between Ukraine and Russia. But Algeria was really investing a lot in natural gas on both, on oil. But this is now the problem. For natural gas and for the oil industry, you cannot really get return investment in 1 year. If you want to develop a field of oil and gas, you need, like here in Algeria, you need like from 7 to 15 years to develop a field. So the war just started in 2022, and war in Ukraine. And that time we have seen a big demand, a big gap. And Algeria at the moment investing $50 billion from now to 2028, $50 billion. In 2024, Algeria is investing $8.8 billion. 71% of them are going to EP and to develop natural gas. So this is the big investment Algeria is orientated at the moment, and this is the big concern. So if we talk about oil, Algeria production is a little bit steady. It's like 950,000 barrels per day. It's steady for many months and for several months. And Algeria is sticking to the OPEC organization and its commitment for voluntary cuts, and Algeria was engaged in that. So if we look at the oil industry in Algeria, and even for natural gas, Europeans mainly are looking for more on natural gas, and the message from Algerians is so clear. If you want more natural gas from Algeria, you need to invest, because national oil company Sonatrach cannot really respond to this request solely. So it needs more investment to invest, and we need more investment. But meantime, Algeria is investing in Libya, and as you know, Mauritania and Senegal discovered natural gas. So a national oil company expanding its investment out of the country. But at the end of the day, the market needs more natural gas for our region, more than oil, because we have oil. We don't have issue. In Europe, they don't have problem of oil. They have problem of gas, but they need a steady supplies. You remember a few months ago, what U.S. administration decided to pause the LNG project. So that was really a big issue, critical issue for European leaders. And they were really all the time seeking for steady supplies. And Algeria, with its supplying, as you know, 70% of natural gas to Europe through the pipeline. So Europeans are looking for steady supplies of natural gas, and I think Algeria is the core, is the main supply, will be
certainly one
supplier.
of them. We've seen Norway obviously benefit greatly. We've seen the US come in to fill that Russian gap, but of course it's going to take many actors. Peter, we've talked about where the Fed may go, obviously meeting tomorrow, and general expectation, keep everything as it is. Europe, however, has the ECB seen enough to give it a green light to cut and diverge from the US?
I think that's very much in their mind's eye, Sean. How long that timeline until they actually press the go button, there's no doubt that they need a cut. And when you look at as far as consumer sentiment over the last couple of years, it's quite not only anemic, it's pathetic. And then you've got the overall picture as far as Germany, manufacturing, what's going on across France and Spain. So the whole zone is pretty much underwater. And you had a flat, remember that the fourth quarter was 0 GDP. You've had an uptick at 0.2 for the first quarter of this year. So yes, while that's a little bit of green shoots, Sean, I think it really does need a shot in the arm, and a rate cut is very much on the radar, and possibly you might see that by summer.
Even with a little bit of inflation still on the table, they got to swallow it to get the economic engines moving.
Absolutely. I mean, it gets to a point, Sean, as you know, it gets to stagflationary, because you've got the inflation ticking higher and you've got very anemic growth. And if it needs some help, and I think that rate cut would certainly help things. I think that'd take a little bit of pressure off the euro as well, and trade king dollar.
Dollar remains, and where it goes from here, of course, as mentioned earlier by Noor, a big impact for Asia. Let's go to the survey question and pick up on this theme that we've been looking at this morning. Oil fell 1.5% yesterday after the New York Times reported that Israel is open to a truce involving an initial release of hostages in Gaza. How much geopolitical risk premium still remains in the oil price? Is it $3 or less? Is it approximately $5? Is it $6 or more? Or is it none? All drained, all done. Your thoughts on where that is, the oil price, from a point of view of the remaining geopolitical risk in that, as we trade below $90 a barrel. The question of that. Noor, China's manufacturing activity expanded in April, but at a slower pace. And I'm just wondering how to read that. We still have the Purchasing Managers Index dropping to 50.4 from 50.8 last month, but still above the 50 mark, which separates growth from contraction. So China's not, fallen off a cliff here. It's still thumping along, but maybe not, too much above the 5% target growth for the year. Your thoughts on reading these monthly data figures from China?
I think that in terms of the China, okay, so there are, as I say, it is still a bit mukish. The GDP growth in the first quarter, as you said, was a bit higher in the inflation adjusted terms, right, against the IMF's 4 to 6% projection. But real growth exceeded nominal growth owing to the producer price deflation. So, and I think that the downturn in the China real estate sector is offsetting Beijing's fiscal stimulus measures. So I think that the slowing income growth is eroding the household consumption. So that's been we see that as the big driver of the changes in oil demand. So
do we see anything? Obviously, Singapore is a bit of a bellwether for the health of China. Obviously, your biggest everything. Is that translating into the data figures for Singapore this year?
Well, you can see that the refining margins in Asia is still pretty weak, and a lot of it is being pulled down by diesel. And what we're hearing is that while the Asian refiners are not yet cutting runs, some of at least one South Korean refiner is already trimming its refinery runs. So I think that the demand for products is still under pressure. A lot of it is diesel, and that is putting a lot of pressure on the refining margins in Singapore as well as in North Asia.
Shoaib, we have this discussions regarding truce in Gaza, or at least a ceasefire, a temporary ceasefire. The Arab countries and others meeting in Riyadh over the weekend and in Egypt this week. Your thoughts on the outlook for that from a North Africa? We haven't heard much from North Africa vis-a-vis this terrible crisis, but looking from your vantage point, does this look like it's reaching that destination?
Oh yeah, I think there's some politics are playing their role at the moment because, as you know, the U.S. administration is preparing for the elections by the end of the year, and any high oil prices will not serve the electors in the United States. So I think that this question
we have 80% of electorate between the ages of 18 to 24 in the US. The polls indicate that they are very disappointed with the Biden administration's policy vis-a-vis Gaza. That's a very significant voting bloc for Biden.
Exactly, absolutely. So the question I may ask, why the U.S. administration left all this time, 7 months without a ceasefire? So why they left this, postponed this negotiation to now? We are in May. So I think the U.S. administration is preparing for the elections, and the U.S. administration is aware that they will have a good high demand on oil in summer because we'll have travel. Everybody will travel in summer. We'll have demand on fuel and gasoline. So there is autonomous demand on oil in summer. So if you will have two challenges at once, you will have war, geopolitical conflicts, and you will have automatic high demand on oil. So systematically, oil prices will increase. And the risk, if the OPEC Plus will decide to extend its voluntary cuts to the third quarter of the year. So this is the big problem. The U.S. administration at the moment is trying to lessen the impact of the higher prices and want to end up the summer at least with the price of $80. And I strongly believe that in the upcoming weeks, just 3 or 4 weeks, I believe the oil prices will continue to go down, maybe to $80. but we still pending till the decision of the OPEC Plus. And I think the U.S. administration is observing this closely, because it will take a decision on that. Based on the OPEC's decision related to the voluntary cuts, I think that U.S. administration will put more pressure, because the U.S. economy is not supporting more burden of high prices. High oil prices, $90, will not serve the U.S. economy, will not serve China, will not serve the biggest economies in the world. So what they need at the moment, need to balance the conflicts in the geopolitical problems and risks. And I think if we lessen this impact, we still have fundamentals, oil and demand. I think we can spend summer with like $80, $85, and we'll serve all the global economy, I believe.
That's you might get some sort of ceasefire in Gaza, but at the same token, the American administration's put $60 billion of new weapons into Ukraine, which of course you would imagine heats up on the back of that kind of weaponry. Peter, one of the reasons it seems that oil prices have come off a little bit, if at least the momentum that we saw them move above 90 a barrel in earlier in April, the investors from sort of fund managers, hedge funds, and so forth, sold at the fastest rate for more than 6 months. Once the sort of Israeli-Iran face-off seemed to sort of fade away, and the appetite for that volatility had gone. Your thoughts on what role the hedge funds and investment funds, the paper money, if you like, are playing in this market and will play? If they don't have appetite, very difficult to see oil prices going above $90.
Well, a couple of things. Exactly right, Sean. And I just want to say another side. We spoke briefly about China. China's up for the part of the CSI 300, has had a bounce since the start of February, up 16%. So don't discount China. It's on a tear, and you've only got to be at 20%. You've got a raging bull market. So that's in less than 3 months. Now, I think what's happened, the smart money, Sean, they saw that situation with, I think it was evaporated. It was too hot, and that hot air blew off. People said, right, that there's no more upside as far as crude. The smart money jumped into gold, and they ramped it up, and it rode like a stallion on a beach, just absolutely flat strap, and it went to 24.40. That was a solid push up, and then the smart money, naturally, that evaporated out. And I think they've just been trades over the last couple of weeks. Smart money has found opportunity, and I think the smart money has now gone into copper in the last couple of sessions, and that's probably where you're seeing activity. So it's been a dynamic month to trade commodities, first oil, then to gold and silver, and then to copper.
What about, Peter, just to finish off, yen at over 160? I mean, I don't even know where to begin to analyze that. What is that? I mean, it's been a slow progress, not that slow, but ultimately we broke out of that classic historical 1 to 110 range on the dollar. Yeah. Now we're up above, breaking through 160. I mean, and the Japanese economy seems to be taking it in its stride. Where are we going with this?
Well, yeah, I mean, Sean, I think it certainly bounced, and everyone's saying it was probably interventions to some extent yesterday. It hit 160 a bit above, and now it's at 156.70. So, yeah, there's been no word of it, but I'm sure that something's happened to really get that big leg down. And there's probably going to be, again, wild gyrations in the yen. When you're at this sort of level, and this is what all traders have got to be mindful of, you can get swept out very, very quickly trading, with leverage. So I think that we're waiting to see what happens as far as Japan. Put your mind back to 85, and I can, as far as the Paris Accord, and it was at 242. So it's still, I'm not surprised to see the yen probably tail off. You've got to be conscious. Nikkei 225 on fire, went up. It's about 38,000 now. It's cheap for the Japanese. You've got an aging population, and you've got the other side of it, a raging stock market.
Well, we're going to have to leave it there with a raging stock market and a survey result that, at least in this room, tells us that the geopolitical risk is down to $3 or less. Another 1/3 of the room thinks it's still up at around $5. Well, we'll have to see, put your bets. So if we do get a ceasefire announcement out of Gaza, will that price drop further, or have we already seen the drop in anticipation? Time will tell on that. Going to leave it there with Shuaib Boutanin in Algeria. Thank you so much. Peter Maguire in Australia. Thank you very much. Noor Aslan Ahmed in Singapore. Really appreciate your comments and insights today. We've got Brent crude oil trading. Little change this morning in Asian trade at $88.22. Still sort of significantly below that $90 handle. Is there any momentum to get it back up there? We'll have to wait and see as the summer driving season is upon us, with the famous Memorial Day weekend in the United States only now a few weeks away. Thank you, everybody. Have a good day. Bye-bye.
Thank you very much.